Hi guys, today we'll be discussing Apple stock ticker AAPL, which has surged over the recent weeks to reach a 3 trillion market cap. Its current price sits at $182 as of 3rd January's close, but I'll be explaining why I'm not rushing to buy the stock, but I'm hoping to accumulate the stock in the range of $170 to $180. Let's quickly go over Apple's business. As of its latest annual report, it continues to derive over half of its annual revenue from the sale of iPhones, but we can see a growing proportion of revenues from wearables and services. As defined by the company, wearables, home and accessories net sales include sales of AirPods, Apple TV, Apple Watch, Beats products, and other accessories. Services include sales from the company's advertising, Apple Care, digital content, and other services. By geography, Apple derives most of its revenues from US, but also some from Europe, China, and Japan, which are mature and competitive markets. Taking a look at its revenue growth, the company posted a compounded annual growth rate of 12%, or CAGR of 12%, over the last 5 years. It posted an incredible year in FY21, and we'll be looking at results shortly on the next slide. In terms of margins, it also posted an impressive set of results, as EBITDA, which are earnings before interest, taxes, depreciation, and amortization, jumped from 28.2% in terms of margins to 32.9%. According to its annual filings, Apple posted double-digit gains across all its segments. Its iPhone net sales increased during 2021 due to newer models launched in the first and fourth quarter of 2021. While the results were impressive, for the most part of 2021, Apple's share price trended sideways up till November, with investors worried about a material procurement cut due to supply chain disruptions and iPhone demand. However, after news that supply chain disruptions have mostly eased and iPhone sales remain strong, the stock price has rallied strongly in December and also aided by a flight to safety to large cap stocks in the light of the upcoming Fed rate hikes. My personal investing horizon is a longer term one, and today we'll be going through the reasons that make Apple a long-term hold in any stock portfolio. My first investment thesis is that Apple is the world's leading technology platform, with innovation efforts consistently reaping high rewards. My second investment thesis is that there will be sustained growth in high-margin services segment, which helps to insulate Apple against discretionary replacement cycles of the iPhones. And my last investment thesis is that investments in augmented reality and virtual reality and other growth verticals such as autonomous driving also offer massive potential. Some of the key risks, of course, would be firstly, unexpected supply chain disruptions leading to higher logistic costs and procurement difficulties, a weak iPhone demand, and a material slowdown in CY22, which are calendar year 22, due to weaker consumer spending, lower services segment growth causing margin deterioration, and investments into new areas not reaping any fruition, representing poor capital allocation. And lastly, this video will cover whether the valuation of Apple is reasonable. So for our first thesis, Apple is a leading technology platform with a proven track record of innovation. One case in point is its wearable segment, which only generated 11 billion revenue in FY16, but now generates 3.4 times of that amount. In fact, Morgan Stanley said in its research that around 6% of Apple's revenue on average in any given year has been generated by products or services that did not exist 5 years prior, which speaks volumes about Apple's success in pushing out new growth drivers. The second thesis is that the continued monetization of services will continue to help with the margin uplift and insulate financials against consumer spending. According to its annual report, the gross profit margin of services is almost twice for services versus its product segments. Likewise, the growth in this segment has also been tremendous, tripling in almost 5 years. There was a recent lawsuit between Apple and Epic Games which ruled that Apple cannot keep developers from redirecting customers to alternative payment methods outside its App Store, but it's likely that this impact will be negligible. And our final thesis is the potential of AR and VR. Besides autonomous driving vehicles, Apple is also pushing into the forefront of AR and VR, and market research has shown that the potential of this market puts it at a CAGR of 40.7% over the next 10 years. Apple already has numerous patents relating to this area, and I can almost be certain that they'll be a player in the future. In addition, Apple is well positioned to rule the metaverse given that it runs the largest mobile ecosystem in the world. So with all this, is the valuation of Apple justified? By means of historical valuation, Apple is already trading at 32 times. In terms of PE, forward PE, almost 1.4 times of that of S&P, which is already elevated given the Fed stimulus. It is also trading way above its 3-year mean. Therefore, it certainly is a high multiple at first glance, and the worry on most investors' minds would be a contraction of multiples given the impending rate hikes. On a relative valuation basis, we can see that among the FANG stocks, Apple trades more expensively compared to Alphabet and Meta Platform, but is undervalued compared to its other peers. Among its peers, Apple also has the slowest growth profile over the next 2 years, which raises concerns that it might be overvalued. Following this, I also did a DCF to do a sense check on what kind of numbers are baked into Apple's current share price. Assuming a cost of equity of 7.5%, cost of debt of 2.5%, I arrive at a WACC of 7.3% for the company. I believe a 10-year DCF at least is warranted given the potential of its newer growth verticals. In terms of revenue, EBITDA, and EBIT assumptions, these were based off broker consensus numbers of CapIQ up till 2024. For projections after that, for revenues, brokers are saying that they will expect monetization from ARIVR to come more materially after 2025, and therefore I factor in a slight jump up to 10% growth rates in 2025, further growth to 15% in 2026, and a straight line decline thereafter to 3% by 2031. To some extent, these growth rates already factor in contribution from new growth verticals as Apple's core growth areas are not growing that fast. These are definitely very rough estimations, but they serve to kind of give us a sense check about what is baked into a price. For EBITDA margins, I'm assuming an eventual increase to 35% in 2031 with the further ramp up of the services segment. With these assumptions, I have arrived at a target price of $176. That being said, I do acknowledge that if Apple manages to achieve a lot of successes in new areas, the runway for growth and growth rates could be significantly higher, meaning that there could be much more upside in the target price. However, given the uncertainty about how new growth strategies will play out, I would like to be more conservative in my valuation for Apple. To conclude, at current prices of $180, I will hope to see a slight pullback in price action before taking an entry position in the stock. That's all for today's video. If you enjoyed this, remember to subscribe and leave a comment down below.